Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Don Durrett. So for those of you who don't know Don holds an MBA from California State University, Bakersfield. He has been a gold investor since 1991, with a focus on junior mining stocks since 2004. Don is an expert gold and silver mining stock analyst, author, and founder of goldstockdata.com, a website for gold and silver mining stock data. Don is also the author of How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. His gold and silver mining stock newsletter is widely regarded as one of the best. So Don, it's a pleasure to have you on the show today. Thanks for being here.
Yeah, thanks for having me on. Appreciate it.
No problem. So Don, let's kind of get kicking here. Tell us a little bit about yourself. Where did you spend your formative years growing up? How did you discover the precious metal space? And what has inspired you to teach people on how to invest in gold and silver stocks?
Okay, so a little about myself. So I was born in 1960. I grew up in the 60s and early 70s. So my foundation or my values was living in a very free world. I mean, growing up in the 60s, that was before computers, if you will. It was, a very easy living time. So that was kind of my foundation. So I grew up with kind of libertarian attitude of freedom, because America at that time was, the freedom was very, very high at the level. So that was kind of where I came from. So I always wanted to kind of go down that path, if you will, maintain it. I was never somebody who was kind of an institutional person. I never really was interested in politics or kind of organized religions or, kind of big industries, if you will. I was always kind of an iconoclastic person. I think that's kind of what led me to gold and silver, because gold and silver is kind of a natural place for like libertarian views and people that are kind of, I don't know if freedom oriented is kind of the right way. So it led me down that path. So I was, when I actually started investing in gold in 1991, I believe, a long time ago. And the reason why is because I never really felt comfortable with the stock market. I always thought that it was a bit of manipulation involved in society as a whole. And this comes to basically your overall theme of living the greatest life. So I was always somebody who had aspirations. I don't know if it was living in the 1960s, but I always had high aspirations for humanity and for society, that we could achieve our highest ambitions, our highest goals. But it had to occur through virtue, it had to occur through humanity, it had to occur through morality. So I always had these really, really high ideals. And so I always felt that society wasn't really living up to them. I mean, what happened in the 60s, where we basically killed both the Kennedy brothers and Martin Luther King, society basically killed them, in my opinion. And basically that was kind of the end of America's innocence. And it kind of turned me a little bit sour. I became now I was more of an analyst of society. And I still am. And so ironically, it fits in with your theme, the greatest living. So I was always trying to kind of attain that. And then I actually turned towards spirituality, my late 20s, and that made me even more focused on living that kind of a lifestyle and helping humanity to achieve its highest ideals. Always been an idealist. I basically got into nutrition in my 20s because I felt that living healthy was important. That kind of fit with living your highest ideals. So it went there. And then, so between the health, so I was focused on health, always focused on spirituality. And I've been on a spiritual path for 30 years, and I started writing spiritual books in 1990. So I actually started writing the spiritual books and getting involved in gold investing about the same time. And now I'm still doing the gold, and the spirituality, I think, is something's going to head there. That's kind of probably my next step, my next path in life is basically helping people to understand spirituality the way that I've helped people to understand gold and stock, mining stocks.
Thanks for giving us that background there, Don. Moving into now kind of the mining space, precious metals lost momentum in June, recording the worst monthly performance since November 2016. The strengthening US dollar, along with the firm trend in equity markets, affected sentiment toward precious metals. Reports that the US Federal Reserve will start tapering bond purchases and their decision to raise interest rates in 2023. So, Don, can you explain what happened? Why did gold and silver mining stocks continue to decline while the price stabilized?
Well, we'll go back a little ways. I won't give you a 10-minute answer for this, but I could. Gold, and I'll just talk about gold here, but silver basically has followed the same path. So gold from peaked, it went up to $1,935 in 2011, and then it started going down. And so 2012 and 2013 and 2014, it basically crashed and it went into a channel. So from 2013 to 2019, for 7 years, it was in this channel below 1370. And then in July of 2019, it broke out of the channel at $1,370. And that's when I believe the bull market began. And so then it went from 1370 all the way up to $2,075 in August of last year. So that is when we basically went into a correction. So we had this massive breakout from 1370 all the way to 2000. But that wasn't the end of it, I do not believe. I don't think that's the end of the bull market. So we basically have been in a correction since August. Now, gold didn't basically start down in June. That was just an intermediate little correction, if you will. We had a little move up, of $100, but we're still basically in this channel from 2075 down to 1640, 1650. So we've been in this big channel of about $400 since August. We're still in the channel. So we didn't really stop. All we're doing is kind of rinsing and repeating in this channel, up and down in the channel. But I firmly believe, and I've been saying this since January, February, that gold is kind of trapped and silver along with it, as long as you're in this channel, this correction channel. In order to get out of the channel, it is my firm belief that the only way that you do that, basically make another all-time high, which is the only thing I really care about. I don't care about little $100 and $200 moves because it's kind of a rinse and repeat. I want a breakout. And we'll talk a little bit more about that breakout. So what is going to eventually cause this breakout is the fear trade. The only thing that makes big money, and big money is the only thing that can really move the gold market, which is really a large market, trillions of dollars. You need the big money. The retail crowd isn't going to move it. So you need big money. The only thing that's going to get the big money to buy gold is fear. They only buy gold when they have to buy gold. The big money starts the trend, and then everybody kind of jumps on board. And that's when you can't stop it. That's when you get these big runs. That's why you had the run from 1370 all the way up to 2000, is that people were starting to think that this move that we've been in since 2009 is possibly coming to an end. And then we're going to start to correct. And COVID is basically what's causing that fear. And so once fear gets high enough, and right now we have MMT, modern monetary theory, that's basically making everybody really comfortable on Wall Street. I say everybody has their party hats, and they're basically taking their MMT euphoria pills, and everybody thinks, that the party's just going to go on. It's the roaring 20s. But I think that soon, and I'm saying within the next 90 days, it's tough to make predictions, but I think that this binge that we've been on since October, where the stock market has just went straight up since October, we haven't had any corrections, is about to roll over. And we've had this one really strong momentum chart Michael Oliver came out with. It shows that this is really the first time that we've had a breakout in NASDAQ since 2009. It was in October of 2020. It just happened. So we're in this breakout right now, this blow up top, in my opinion. So if that rolls over, then the fear trade should come back. So what I'm thinking is going to happen is we're going to get a correction in the near term in the markets, the general markets, which will push gold down a little bit. And I think it's going to go down somewhere between 1550 and 1650. So we're going to get a pretty good knock here. I'm hoping 1650 is as low as we go. And who knows, maybe we'll get lucky and it won't even go below 1700. And then after that, it'll stay down for a short period of time. And then the fear trade will kick in and we'll start trending higher. And then we're looking at this huge once in a lifetime move up, this bull market. For instance, I think we're going to see gold go from 2,000 to 3,000, possibly as high as 3,500 in the next rally, the next move, which could take 2 to 3 years, and silver to go from 30 to 50 or higher. So it's set up unbelievably well for this huge move in gold and silver. But it might not happen. This is all speculation, but that's what I do. So sorry for the long answer, but it's not an easy question to answer.
Absolutely. So Don, in the last couple of years, you kind of touched upon this, how gold had reached a high last August, and then as well as silver reached a high earlier this past year after January. There's been a lot of attention since, so much that many millennials have tried to squeeze the silver price. However, this movement did not last for long, and some investors were in it for the short term. What are the reasons that millennials should think about investing in gold and silver stocks and holding?
Well, it depends on their personality. So this isn't really investing, this is speculating. Silver is very volatile. It's really not for somebody that doesn't have a high risk tolerance. So that's the first thing. For instance, if you like crypto and you want to make big returns, then this is good for you. But the one thing that I really recommend is you have to be careful. You have to understand exactly what risk you're taking on. So if you go to my website right there on the main menu, there's an option called book. You can read my book, and that's going to help you to understand exactly what risk levels you're taking. So, if you're a millennial and you really want to, make some big money quickly, if you will, you like the crypto. For instance, I invest in crypto. I really like it. I have like 5% of my allocation in crypto. I've been very successful in crypto. I got in early because I always, look for risk reward, and, they made sense to me early. I still do that. I still invest in crypto, but let's go back to gold and silver. Gold and silver opportunities. So what you want to do, if you're a millennial and you want to make a lot of money, is you really want to focus on basically turning like $10,000 into $1 million. So how do you do that? Or $5,000 into 500,000. How do you do that, right? Well, the first thing you can do is one stock at 10,000. It's a 100 bagger. There's your $1 million. Or you can do 10 baggers. 4 25 baggers. So what I do is I try to find stocks that I think are solid 5 baggers at my projection with 10 bagger potential. So if I'm investing in a whole bunch of these stocks, I'm probably going to find a bunch of 10 baggers, and I'm going to, do extremely well. And once in a while, I'm going to find my 100 baggers. Like, First Majestic, I got in at like $1, right? And it's probably going to go to 50, I think. So Kirkland Lake was another one that I got in low, and it's probably going to go to 100. So you can find these stocks, that the outliers that do extremely well whenever you're trying to find big returns. So the key here is, one is understanding if a stock has upside potential, like if it does have 5 bagger. So the way that I do it is I project future cash flow. So I take future cash flow based on future production, future cost, and future gold or silver prices. So I'm projecting out into the future of what I think their future cash flow is going to be. Then I give them a multiple of say 10 or 15, rarely maybe 20, but usually 10 or 15, depending on the quality of the company. A quality company, for instance, like First Majestic, I'm pretty confident it's going to be a 15 free cash flow multiple. So I do that's so I can project out and I can see, okay, this is what it could be valued at if they hit this production number and silver prices reach this level. So I can project out and say, wow, I can basically find, 5, 10, 20 bagger. I can find those and I can take the risk. I can speculate and I can make a lot of money very quickly if I'm right. This is very similar to crypto. You're basically speculating that these things are going to really fly. And you look at the use case and, and basically you're hoping for some really big returns. It's the same with the gold and silver miners. You're hoping for some really big returns. Now I'm talking about, there's other ways to do it, but I think if you're going to take the risk of investing in gold and silver, then you want to have big returns. But some people, they're so happy with like 50 or 100% return that they'll focus more on the quality companies, the quality major producers, for instance, or the royalty stocks. They're tickled pink if they make 100% in a year. I'm not. I want the big rewards. I want the 5 and 10 baggers. But I do invest in the majors in order to diversify my portfolio, so that if the stock market crashes, my portfolio doesn't go down 80%. So I do that, and I write about it in my book. But some people are more aggressive, and they'll basically avoid some of these lower return stocks and focus more on the higher return. But yeah, this is kind of a once in a lifetime deal here, because for instance, we've never seen silver above 50 ever. It went to 50 twice in 1980 and in 2011, 1981, 2011, twice. That was it. And both times it only stayed up there for a month. That was it. It stayed at $50 for a month and then started crashing. So this is really the first time ever that silver has a chance to really have a serious bull market. So you can imagine the potential. The valuations could just get nuts. As a matter of fact, I do not even value silver miners above $150. I just think it's nuts. The valuations just go so high. It's like I don't even need to project that high. At 100 or 150, it's already pretty crazy how much upside they have. But if silver ever does go to 250, 300, which is kind of crazy talk, it's kind of, that's why I don't even value companies that high. But if it ever happens and you have a small position, you're just going to make a boatload of money. So it's like I said, speculation.
So Don, you have been through different cycles before. You've seen the bear and you've seen the bull. Do you have any advice on how to deal with the highs and the lows of owning mining stocks through these cycles, especially now as we face through a tough period of consolidation and lower lows?
Yeah, good question. So there's two ways to invest. One is to be a trader, and I guess there's three. One is to be kind of an aggressive trader, where you basically have a small portfolio of say 20 to 30 stocks, and you're riding the winners, and you're basically getting rid of the dogs. Anything that drops 20 or 25%, you're taking it out. You're only basically riding those winners, and you're pressing your winners. That is the best way to invest, and that's going to protect you against any type of a correction, because you're basically going to get stopped out. So anytime we have a major correction, you're getting stopped out because you're protecting yourself. That's the ideal way to invest, because you're basically going to capture the upside. Whenever it runs, you're going to be positioned and you're going to press those winners, and you're going to do really well during the runs, and you're basically not going to participate in the corrections. Yeah, you're going to go down, your stocks are going to go down 20, 25%, but a lot of those stocks are going to be up. Before you basically stop out, you're going to be up, and you're going to be ready to jump back in again. So the ones that get stopped out, you're going to be waiting for the bottom, and then you're going to get back in and you're going to trade. That is what I call a hardcore trader. And that's the best way to do this, because if you have the right mentality, it takes a right mentality to be a trader, because you got to be ready to get stopped out of 25 stocks. And I don't have that mentality. Plus, you have to have really high allocations per stock. I mean, let's say you have $1 million portfolio and you only have 20, 25 stocks. You have some real high allocations there per stock. I'm not comfortable with that because of the very high risk, high volatility. But if your mentality is, I don't have a problem with high allocations, I don't have a problem with trading, you're going to make the most money. You're going to do a lot better than me. As a matter of fact, you're probably going to do extremely well if you have that mentality. That's the first way to do it. That's the safest way to do it. The second way is to have own more stocks, say, let's say 30, 40, 50, and you don't have stops on all of them, and you watch it pretty hawkishly, and you trade out of stocks. You don't want to get stopped out of 50 stocks, but you watch them and you do sell them when you see them go down. So you are kind of a quasi trader. You kind of more on them, watching them, more vigilant, if you will. And that's kind of what I call a quasi trading position. That will protect you to a certain degree. And then the third way is what I do, which is very highly risky, highly speculative. And that is basically a buy and hold investor. So I buy and hold, and I keep small allocations. Like I own more than 150 gold and silver miners right now. Most people think that's insane. And the reason why I have that many is because I started investing in juniors in 2004, and I use small allocations, like half of a percent of my total out. If it's a high risk company, I'll only do 0.5% of my total cost basis or less. And I rarely go above 2% on a single stock. Most of my stocks are 1% or less, and the vast majority of them are under 1%. So I have these small allocations. So once I got to 50 stocks, there's no way I wasn't going to stop. It's like, okay, I'm going to 100 because that was my style, small allocations. I'm not going to bump up my allocations. And I never had the right mentality to trade. So I got to 100 and I thought I was going to stop at 100. But this was, I don't know how, I had 100 by, 2012, somewhere in there. I was already 100, maybe before that. So I had 100 pretty, early, and, we've been 10 years since then. So I just had to keep buying. I just kept, and I basically consider myself a collector. I collect stock more than I invest in, but these are high risk speculative investments. I don't know which ones are going to pay off big. Remember, I'm going for 5 to 10 baggers. Sometimes I'll do 3 baggers for higher quality stocks. So I have a lot. I'm actually overweight too much the developers and explorers. The last time I looked, I think I was at 26, 27% exploration and development as a whole. My explorations are around 7, 8%, which I think is a little high. So I have a lot of developers. Ideally, I would like to have 20% exploration and development. So I'm a little heavy there, but I'm still adding. I mean, it's kind of nuts. I mean, the reason why I don't want to add, but I have a buy the dip list that I started collecting back in February because I thought we were going to have a dip. And my buy the dip list is at 12 stocks right now. So if we crash tomorrow, the HY goes down to 230, I'm probably going to add 12 more. And in addition to those 12 more on my buy the dip list, I have 5 additional ones on my watch list. So I'm kind of going nuts here on my collecting. I say that I need an intervention. I own too many stocks. But Eric Sprott owns more than me. Last time I looked, he had like 175. On my website in the gold, you can actually go and see all of his stocks that Eric Sprott is invested in. So he loves to spread it around like me. And we're trying to find the big returns. But he focuses more on exploration than I do. He can get away with it because he usually gets in early and he usually gets warrants, and I don't. So that gives him a big advantage where he can kind of get away with focusing more on the exploration dev. But I actually recommend, if you get into this, that your total allocation, your total cost basis for exploration dev, the really, really high, is 25% or less of your portfolio.
Okay, great. Thanks, Don. So this leads me to my next question. Many people believe that we are approaching another stock market crash. But Don, do you think this is true? If so, what would happen to precious metals and miners?
Yeah, good question. I want to follow up one quick comment on the previous answer. And it's basically, you said, okay, what do you do when you get these corrections? So I didn't say exactly what I did, but what I do is I buy the dip. And so my portfolio is going to get beat up because I'm a buy and hold. So I was going to get beat up really hard during these corrections. So what I do is I basically hoard cash. So I've been hoarding cash since January. So I basically now 7 months of hoarding cash because I'm waiting for the correction. So I learned in 2008 that you do not want to be caught with your pants down during a correction. You want to make sure that you have some dry powder to buy these dips. And so in 2008, I had enough to buy a little bit of the dips, but I wish I would have had more. And so I learned a lesson there. And so you have to always, you're going to want to be fully invested. You're going to hate cash, but you got to hold on to some for the dips so you're ready. Okay, I answered that question. So now the next one, the crash. I do not think that we're going to see a crash. Now, again, I could be completely wrong, and we could have one. We could have another one like we had March 2020. The reason why I don't think we're going to have a crash is because of MMT. We basically have a mindset today. This is completely flipped from, say, the 1980s and the 1990s, when we used to think of debt as being the most dangerous thing for the economy. You know, we have to balance the budget, the federal budget, we have to balance it. We actually did balance it in 98, 99. I'm not sure if those are the exact years, but right around there, we basically balanced the budget because of our fear of debt. And isn't it interesting that 2 years later in 2001, we basically lost that mentality, went out the window, and we adopted what Japan started, and we gave it a name. We called it modern monetary theory. And the only thing that really represents is the belief, the economic philosophy, if you will, that debt is not the enemy, that debt is not the number one risk, that the number one risk is liquidity. You cannot allow liquidity to dry up, or otherwise the economy goes down. And that the more liquidity you have, the better. So Japan, starting in 1990, started injecting the heck out of their economy. They started, their central bank started buying all their bonds, taking their interest rates down to zero. And then they started buying their stocks, where they own the majority of the ETFs in Japan. They bought so many bonds that their bonds no longer even trade because the central bank owns them all. And the more bonds that come up, they basically monetize them, they print them. And so all through the 90s, Japan was basically printing money like crazy, and their Fed's balance sheet kept going higher and higher and higher. And they did not have inflation. So what happened? 2001 came along, and we basically said, look at what Japan's doing. They're printing money like crazy and no inflation. We can do the same thing. So inflation started, but it started slowly. If you remember, if we go back, so in 2001, yeah, we spent a lot of money. But if you remember, there was a lot of questioning about that, right? They're basically saying, oh, wait a minute, we can't spend, we can't have these huge programs. There was basically back and forth with Congress, where Congress was pushing back. But what's happened today, what happened in 2020 when we had this COVID thing, there was no pushback. It's like, how much do you want to spend? Go ahead. There was no pushback. You want a stimulus bill? You want stimulus money? How much? Here you go, right? So we've lost the whole idea that we even need to have balanced budgets is gone. So this year we're going to have $2 trillion deficit, 3 trillion, maybe even 4, right? And nobody even really cares. So in my opinion, that creates basically a put for the market, saying that, basically the Fed's buying your put, so the Fed's going to make money and it goes down and we're just going higher. You don't have to worry. You don't have to worry about the stock market crashing because the Fed has your back. And all through this decade, not this decade, all through the last decade, whenever we had a stock market correction of any kind, the Fed came in and injected money. And so you can see it, the liquidity immediately, as soon as the stock market went down, they went and immediately popped it back up. So what does that tell you? It tells you that if the stock market falls, the Fed's going to come in, and the Treasury and the Congress are going to come in and inject money. So for that reason, I don't think we'll crash. But what I do think is that we're probably going to go down 10 to 20%, and then we're going to basically turn into Japan. And what I mean by turning into Japan is if you look at Japan's GDP from 1990 until today, they've had very few quarters where growth was over 1%. They basically had very sluggish growth for 20 years, 30 years now. That's a long time. So MMT creates basically a dysfunctional economy, in my opinion. And so I think that dysfunction is what's next. So instead of getting a crash, I think what you're going to get is dysfunction. And what I mean by dysfunction is that you don't get any growth because the banks aren't making loans and we don't know how to price risk. Risk discovery is basically dead in the water. We're seeing it right now. We have this mispricing of bonds and inflation, mispricing of inflation and interest rates. In the 10-year, we're at 1.2% on the 10-year, and we have inflation at 3.5%, even higher than that. So you have this unbelievable disconnect. And so that's what we have. And that's where we have this dysfunction that I'm saying. So I don't think we're going to have a crash, but I think we're going to muddle for the next at least 18 months. Once the stock market rolls over, I don't think we're going to see a new high for at least 18 months. And it wouldn't surprise me if it goes a lot longer than that. It all depends on how much inflation, how much money they inject, but I am expecting an 18-month kind of muddling period. And during that period, I expect the fear trade to kick in and to finally have this once in a generation move in gold and silver. Have my fingers crossed. And, I'm looking at the next 90 days for this correction I'm saying, and that the fear trade to basically kick in by December of this year, maybe November. So November, December, January is when I'm expecting basically gold to get a big bid.
So Don, you often refer to gold as the big dog and silver as the little sis. What do you mean by this?
Yeah, great question. Your question's been very good. So yeah, gold is the big dog because gold leads. It always leads. The reason why it always leads is because gold is such a much bigger market than silver. And so silver cannot really lead on its own. But what it inevitably does is and the other thing is that what pushes gold and silver higher is fear. Remember that people don't really want to buy silver during good times. It's like, why, like right now, the retail crowd, the silver squeeze guys are trying, they're trying to get the retail crowd to buy silver. But by and large, we are seeing shortages. We can talk about that. But by and large, silver's not going to lead us out. And I've been saying that. No, you got to wait for gold to lead us out. So right now, it's really interesting. So gold broke out in July 2019. Silver did not break out until 12 months later in July of 2020. Gold led. It led by 12 months. And that's what I've been saying. Gold's the big dog, gold leads, and it led by 12 months. And silver waited, and it was really interesting. And you can get kind of clues on what's happening. And by silver waiting 12 months, it was basically telling you that it's early. This move, this once in a generation move is not going to happen now. Be patient. It's coming, but it's going to be a while. That's what that 1 year delay was all about. It was basically silver sniffing out basically, the fear trade and sniffing it out and saying it's not here yet. And so what's going to happen is that once gold does break out, and once silver, little sis, once she catches up and she breaks out, she always outruns her brother. But she waits till the coast is clear. And big brother says, okay, you can go now, little sis. And she always outruns him. And so last time in 2011, the GSR went down to under 40. I think it went to 39. Hope I'm right. So the GSR is a gold silver ratio. It squeezed from around 75, 80 all the way down to a little under 40. This time, the gold silver ratio got as high as 120. Today, it's like 75. So if you were buying, silver at that point in time, 120, you were basically almost a 3-to-1 leverage because it's going to go from 120 to 40. 3-to-1. That's pretty huge. That's the leverage you get with silver. So this time, I think that the GSR will squeeze down to under 30. So we're looking at 2-to-1 leverage right now on gold to silver. And so once gold breaks out, the other point I wanted to make is that this time, remember last time, it took 12 months for them to break out. different apart. This time they're going to break out together, which is very powerful, very potent. I don't think people are really recognizing how important this is. The reason, so gold went from 1370 to 2075. That was its breakout. It stopped at 2075. Silver went from 1850 to 29. They're both now trying to break out together above those two levels. So they're both trying to break out at the same time. This is really important in my opinion. So once one of them goes, the other's going to go too. Now, it wouldn't really shock me if we get over 2850 before we get to 1950 on gold. That's a possibility. I'm expecting 1950. So those are my breakout numbers. Once we get to 1950 on gold, I think that the 20,075 is going to be like a magnet. You're not going to be able to stop it. Same with 2850. Once you get to 2850, I think it's going to be a magnet to 30, and then you're kind of off to the races. That's the reason why my breakouts are below the all-time highs. But you have this setup that's pretty amazing, and so kind of that's the reason why. And so yeah, the big dog has to lead. So I always focus on gold. Gold, you got to focus on gold, and then you look at silver. When's silver going to basically catch up and then outrun gold? But silver doesn't outrun gold until the coast is clear. You have to realize that. And what is the coast clear? What does that mean? It basically means that the fear trade is running. The fear trade's alive and well. So basically, you can think of little sis as running away from fear. She's sprinting as fast as she can.
Thanks for sharing that analogy there, Don. This leads me to my next question. You are known to be very bullish on gold and silver. You even made a forecast that gold would rise to 2,500 an ounce. Can you comment where you see the price of gold and silver landing by year end?
Yeah, sure. And then I'll give you future predictions as well. So I do not think that we're going to have a big breakout this year because everything has been kind of delayed. And what I mean by delayed is COVID. So COVID has basically delayed the economy. For instance, I'm not even tracking the economic numbers yet because we haven't really went back to work yet. So they're kind of fake, they're false. We can't get any reading out of the PMIs. We can't get any reading out of the jobs numbers. And so for that reason, everything just keeps getting delayed. So that delay, I think, is also delaying kind of the breakout in gold and silver. So I think that it's possible that we do get above 2,000 in gold and above 2,850 this year in November, December. I think that's a possibility, but I'm not expecting 2,200. I don't think we'll get to 2,200 this year, and I don't think we'll get to say 32, 33 this year. I mean, those lower levels, those are kind of the high end possibilities, but the odds are we don't get that high yet. It all depends on kind of this bid that I'm talking about in November, December, how strong that bid is. December's can be pretty crazy. December's can be some really, really bullish months for gold. And so, and January too. So December, January is going to be interesting to see. If we're under $1,900, say December 1st, that's going to be very disappointing, especially if we're under 1,900 January 1st and February 1st. That's going to be very disappointing for kind of gold, silver bugs. So I'm really hoping that next year, 2022, is the year of gold and silver, and that those are the breakout. And we see some really, really high numbers. We see in 2022, we see a new all-time high in silver above 50. And we see gold above 2,300, potentially somewhere between 2,300 and 2,500 in 2022. So I'm bullish. I'm hoping those are the numbers that we see next year. The only thing I see stopping that is the economy. So if the economy is strong, then the big money is not going to buy gold. And, who knows? We could be at 1,700 or 1,800 or 1,900 gold. And, November 1st, December 1st, January 1st, it all depends on the economy. We could still be stuck in this correction. I'm hoping that we get out of the correction, but nobody can know. It's all basically projections. So I use charts, I use historical macro, I use current macro, and I just try to make my guess based on looking at all those factors and, looking at this closely, for 16, 17 years. So.
Okay, great. So Don, you are an expert at teaching people how to invest in gold and silver stocks. So I want to be able to take the time now to ask you some questions that are specifically related to that. So when looking at mining stocks, it is necessary to understand the life cycle of a mine as a whole. Typically, a successful mining story will start as a junior and progress through a major, increasing in value and size along the way. There are 5 key stages that all miners follow that form the backbone of mine development. Don, can you explain the life cycle of a mine?
Yeah. So there's actually 2 different life cycles, if you will, in mining. The first one is probably what you're talking about is really the progression, the potential progression of a company, how it can basically grow into basically a junior explorer all the way up to a major. And I actually break juniors down. I think I have like 7 categories just for juniors, which is part of that life cycle. But I want to start with, so they can read my book again. So the first life cycle that's actually kind of more important, if you will, in junior mining is understanding what it takes for a company to make a discovery all the way to production. But the problem with explaining that is it takes at least 20 minutes. It's a lot of steps. So the one thing about juniors is there's lots of different types of juniors, and it takes at least 2 years to understand how to invest in gold and silver mining stocks, in my opinion, at least 2 years. And then it takes 10 years to be an expert. It's just complicated. I mean, for instance, like I said, there's like 7 different types of juniors. Okay, so the starting point is really your early exploration plays. So your early exploration plays have a ton of risk, but the biggest one is share dilution, and it's very, very difficult to find a mine, to find a large mine, to find an economic mine. And people are always chasing these juniors. I have 850 stocks in my database. Vast majority of them are these junior exploration plays, in micro caps, but I keep them in my database. And people are trying, and all of these junior exploration plays, only about 1% or 2% find, an economic mine, maybe 3%. That currently don't have one. I mean, find a new one or find a new discovery that kind of, people don't know about, kind of the other ones. So what I highly recommend is you don't invest in a company, a junior explorer that doesn't have the goods. Just because they basically say they're going to find it, or they basically say, okay, we have surface samples. Every once in a while, surface samples, turn out into a big mine, but that's not the norm, if you will. I prefer to wait until you have confidence that they have the goods. I call it, they have the goods. In other words, it's a drill story, but it's a good drill story. It's going to basically be growing. But even those drill stories have a lot of risk in them, because you don't know exactly if the drill stories are going to continue, how big the deposit actually is going to be, how big it's going to be, and then how they monetize it. A lot of times these drill stories can go on and on and on, year after year after year. And every single year, they basically dilute more shares. So let's say you get in at 25, 50, $80 million, and you buy, let's say the share price is at $1. Well, the longer it takes them to drill out this deposit, every year they're going to dilute more shares. So you might have got in at $1, let's say it's at 50 million. And then by the time it gets to 200 million, your share's only at $1.10, $1.20, because they diluted it so bad. So dilution is your enemy, and it creates huge, huge risk. So you have to be really careful with exploration plays, junior exploration plays. Then if you go to small producers, junior small producer, is another big category. You have to be really careful of these because they just don't generate enough cash flow. So you're trying to make, big upside, and 90% of your small producers, at least 80% of them, are not really highly intriguing with a risk reward because they don't have that growth potential, or that growth potential, it's not really visible. You're basically guessing they're going to grow. And so, they really don't have that cash flow potential to get a real high multiple. They're really only based on gold or silver prices going higher, so they get priced higher. You might make a little bit of money there, but by and large, you have to be somewhat careful on your small producers and your small deposits. So the next one, we'll just talk about one more, so we don't have to talk forever, is your mid-tier producers, which the small producers are trying to become. And there's actually a level between the two, which is called an emerging mid-tier producer. And that's a small producer that basically you can look at their production profile and their plans, and you can say, okay, they're emerging. They're going to become a mid-tier producer. And then mid-tier producers have a wide range. I mean, really wide range of basically risk and size of the mine. It's really difficult to understand the different risk levels and say a mid-tier producer that's producing 80,000 or 100,000 ounces, and then one that's producing 600,000, but it's not a major yet. So you have this huge gap in resources, in management teams, in properties, in production. And so it's a really vast area. I don't break mid-tiers up, but you could easily break mid-tiers into three groups as well. So you can start to see the risk and understanding. That's why I mentioned my book twice. You have to read my book to get a kind of an understanding on the diversity of these miners, how to really, peg them, what they currently are, what they're going to be, what the risk levels are, the cost, the production, the exploration potential. Like I said, it takes a long time to really understand this stuff. Like I said, my guess is it really takes about 2 years. You can ramp up in a 1 year, but you really need about 2, and that's kind of on hands. So we didn't do all of them. We did give people a little bit of an overview of kind of these various categories that companies become. But I have about 12 categories that I've broken all these miners into. There's quite a few.
So this brings me to my next question, Don. Drilling is a critical part of the junior miner's exploration process. A good drill essay results can sharply increase the share price, while one set of bad drill results could topple a company until they find a new mine location. A savvy investor should know how to understand a junior company's drill results to make the best investment decisions. But Don, what are the most important things to look for when we're analyzing drill results?
Yeah, so I created a YouTube video on how to do this. So people can go to my YouTube site and they'll find it. So drill results is one of those ones that, remember I said it took 2 years to kind of get an understanding. This is a good example. It really takes 2 years before you can look at drill results and immediately get an idea, is that good, is that bad? So I created a YouTube video to help people. And there's a lot of little factors that come into play. It's a lot of data. It's a lot of information to really take in. But the big one is to know the difference between a good hole, a bad hole, an excellent hole, and a stellar hole. For instance, a gold miner, for instance, anything that's under what I call 50, when you multiply the grade times the meters, anything under 50 is basically kind of speculative, if you will. I want to see at least 50. So 50 is kind of a good hole. Once it's over 50, it's a good hole. But once you get over 100, you start getting in your comfort zone. Anything over 100 is kind of your comfort zone. And then 150 and above, your comfort level is going higher. So the comfort zone starts about 100. And then, so 100 would be like 100 meters at 1 gram on a surface mine. And then 10 meters at 5 grams, that's underground. So it's different grades on underground and surface, of course. but the number, the 51, 152, 500, that still applies for surface and underground. So you really want to see ongoing good results. You want to see a lot of drill holes. Let's say that you own a stock and it's growing in size, or you can look at their historical, and let's say you always want to look for a discovery hole. So if you're investing in a drill story, let's say this mining stock is like, I don't know, anywhere from say 20 million market cap to 100 million. 20 million, you really don't want to invest in a drill story below 20 million. Anything below 20 million and they don't have anything yet. It's all, you want to wait till they kind of have something. The risk is just too high on these micro caps. And you can even go higher than that, 30, 40, 50 million. But investing in these stocks that are under 20 million, the risk level is really, really off the charts. It's really high. You have to wait until you've done this a while and you're ready to really roll the dice, because anything under 20 million, you're rolling the dice. And even, 20, 30, 40, you're rolling it to a certain extent. So let's say that you look at a company that its market cap is say $50 million, and they have a lot of good drill holes, like let's say gold, and there are a lot of good ones over 50. And then they have a couple of stellar holes for their discovery hole. And stellar is something that's over 500. So you really want to have a really nice stellar discovery hole, because that usually all of your big mines that are over 2 million, over 3 million ounces always have a stellar hole. That's just the norm. And so especially any mine that's like over 4 or 5 million, they definitely have a stellar hole. So you're looking for those stellar holes to basically show you that, okay, there's going to be a good sized mine. So you're looking what I call for a flagship property. Flagship for gold is 2 million ounces, and for silver it's 40 million. That's like 50 to 1 GSR. So those are kind of what you're looking for. You're looking for these flagships. And so if you get in early, 50 million, and then they find a flagship, it could easily be worth 200 million, but it all depends at $100 an ounce, but it all depends on how much dilution there is between, the 50 million and the 200 million, because there can be a lot. But you want to look for, and then like I said, you want to avoid these bad drill holes. And so you watch my YouTube video and you learn a lot. But first thing you're looking for is these, if you count and things that are down like 20, 25, 30, those are not good holes, right? So you're looking for the bad holes. So when somebody releases a bunch of bad holes, over and over again, it's like, uh-oh, this mine's not, it's not drilling out well. So you're watching, if you invest in a drill story and you want to see a continuation of these good drill holes, a lot of things that are like between 50 and 100. And every day, if you follow this, you're going to see a lot of drill results.
So Don, when investing in mining stocks, how can a retail investor successfully analyze a company? What are the green lights and red flags that should be identified?
Yeah, that's another one that's kind of too open-ended. There's too many red flags. This is another 2-year deal to really start to understand risk. You're not going to understand risk with me talking 5 minutes about what to look for. It's too complicated for that. But I will say this, that if you're investing in a drill story, you want to make sure, number one, that they have the goods. And if they have the goods, it's got to be valued over 20 million at least, right? That's kind of the bottom floor. Another one is, if you're going to invest in a development story, you want to make sure that the project has a path to production and management is giving you guidance. I've seen a lot of these development stories and management does a poor job of giving guidance. If you're not getting guidance, it's a big red flag. If you're developing, okay, this is a development story and they're going to build, they got a PEA, for instance, and, the PEA says that they're going to produce 100,000 ounces a year. And, the CapEx is 100 million, which is great. Everything looks really good. The IRR is like 40%, looks fantastic, but there's no guidance for production. You wouldn't believe how many times that's tricked me. It's tricked me many, many times. I see that PA, I get all excited. Don't let, just because they have a PA, don't get excited. Wait until you get a real good feel that they are giving guidance on all the steps that are required to get that company, get it into production. Because the good ones will give you guidance, and that's what you want to look for.
Okay, great. So Don, in your book, you mentioned the difficulty of investing in gold and silver stocks. You have emphasized the importance of understanding how to value a mining company. Earlier in your investing career, you made many mistakes. Now you're a confident investor making the right decisions. Don, how do you value mining stocks before making any investment decisions? What is the formula that you follow?
Yeah, this is kind of another one that's difficult to answer in 5 minutes, but I'll go ahead and try. So yes, I made a ton of mistakes early on. And the biggest ones I had just went over, investing in companies that didn't have the goods, investing in companies, development stocks where management basically didn't give good guidance. Those are kind of my biggest mistakes. So you want to look for companies that have the fewest red flags. So first of all, you got to learn what are the red flags. And then once you do that, then when you analyze the company, and I talk about this in my last chapter of my book, How to Value a Company. The first thing that you do is I have a checklist of like 10 things that I go over. And each one of those things, you're looking for red flags. And when you get done with that, then you value the upside. And then once you value the upside, you compare your red flags to that upside. So if I find a stock that has an upside, let's say of 500%, but has a bunch of red flags, that's kind of a no-go because, the risk reward isn't there. But if I find a stock that has, say, 2,000% upside and has like 3 red flags, I might go for it because the upside is so big, it can make a lot of mistakes and I'm going to still make money. But that's where the experience comes in. You have to decide how important are those red flags, how big of a risk, how big of a stretch are you going to make for that company. And a lot of times it comes down to how much dilution there's going to be between now and first pour. Is it going to ever make it to first pour? Because 70% of these quality undervalued developers don't make it to first pour because somebody buys them out because they're so cheap. So that's a big risk. So you start learning these various red flags. Producers is kind of a whole different story. Location becomes really important for producers, location, and then management, how they've executed, and balance sheet's really important. You don't want a company that has a lot of debt. And then the cost is huge. Cost in the balance sheet, what is their all-in cost? How much of a buffer do they have between their break-even point and the current price of gold? How much can that buffer squeeze? And then you're in big trouble. The other thing that I really focus on is the future. So I look at the future. I look at, okay, what is this company currently doing? And what are they going to be doing in 2, 3, 4 years? And then based on that, what they're going to be doing in 2, 3, 4 years, I look and say, okay, how much are they going to produce? What are their costs going to be? What is their free cash flow going to be? What is the politics in that country going to be 3, 4 years? And then I compare that to their current market cap. And I weigh it. And basically, if it looks good, that's what I'm going to buy. So those are just some generalizations. And you're going to learn that on your own if you dive into this.
Okay, so Don, as you are doing your own due diligence on making your next investment decision, what is the single most compelling factor that gives you the aha moment when you then know this is the one?
I'll give you an example. So let's use Guadalupe Silver. So I just did a podcast with their CEO. And what gave me that, oh yes, I'm buying this one. And you don't always get that. You do not. But every once in a while, you find a company that the risk reward is just so compelling, you get excited. Now, most people, not most, but the majority of investors, when they see a stock like this, they invest too much money because it looks like such a sweet deal, such a sweet investment that they overinvest. Not me. I just invest my little small allocation, even though it looks fantastic. because it's not a guaranteed thing. It's still a mining stock. It's still speculation. But I'll tell you what, the reason why I got really excited about Guanajuato is they don't have any red flags. I couldn't find any. That's what I look for. Remember I said there's 10 things to look for? You want to look for the red flags. With Guanajuato, they really, the only thing that can really bite them is if silver prices crash. Silver prices crash, that's going to bite everybody. But I think the floor for silver is at least $18. I don't see us going under 18, and Guanajuato will be fine there. And so the thing that I like so much about them is their balance sheet is fine. They don't have a lot of debt. Management is really, really strong. Exploration is really, really strong. So they're basically they have enough resources to produce 2 million ounces for a while, but the odds are they're going to increase production. But the main one of the reasons why is, okay, so the way that I do it is I look at all the risk, all the possible red flags, I look for them, and then I compare that with the upside potential. So if I find a company that doesn't have any red flags, yet has big upside potential, I get excited. I'm like, oh, yep, I'm buying that one. And so that Guanajuato fit that. It's like they're going to have to, it's in a mining district. I expect them to not have any problems there politically. But Mexico could easily raise their royalty rates. So you got higher royalty rates, and you have higher taxes, and then you have the potential for lower silver prices. But that is what every miner faces. So those are risks that really don't come into play, except for the location risk in Mexico. I mean, if you wanted to be overly cautious and avoid Mexico, which isn't easy to do for silver miners because most of your big silver miners are in Mexico. I mean, you can't invest in First Majestic, for instance, if you don't want to invest in Mexico. So, are those really significant red flags for Guanajuato? Not really. I just think that it has the potential to do really well. So that's kind of how I do it.
So Don, this brings me to my next question. Who are your greatest mentors? Where do you suggest the millennial investors go to better educate themselves before making any investment decisions?
I really learned it on my own because when I started doing this, there was no books. I remember when I started doing this in 2004, I tried to find a book on junior miners. And I sent an email to this one show I was listening to, and this guy named Bob Chapman, who had been doing it for 20 plus years. He's no longer with us. And on the air, Bob said, there isn't any. Sorry, kid. So this was in 2004. There was no books on how to invest in junior miners. So I had no real mentors per se, but I had to listen to who was out there at the time. So one of the guys I listened to early on was Bob Moriarty. His 321 Gold, I think that's the name of his site. I don't read it anymore. So I used to read a lot of his analysis, but I actually kind of got burned because he recommended a lot of juniors that didn't have the goods. So that was a learning experience for me. And the other one, Rick Rule, I've listened to maybe 10 interviews by him. I learned from him, of course. But these were all, most of it was learning on my own. But I'm throwing those two names out there. Grandich, I listened to a few of Grandich. Definitely learned a little bit from him early on. There's another guy that did podcasts. Jay Taylor, I listened to his, some of the guys he had on. So I used to listen to a lot of podcasts and listen to what these guys were saying, but I was self-learning. There wasn't a mentor. It's all on my own. And then the Corlin Report, I used to listen to that one. So now I don't have any that I listen to anymore, except for when somebody recommends. I focus now more on the macro side. I focus more now on Twitter on people who recommend macroeconomics. I'm focused more on the macroeconomic side because I think that will tell me what gold's going to do. So I don't need to focus now on how to analyze miners.
So Don, earlier this July, you published an article called Three Exciting Junior Miners. One of them you've actually already touched on, but could you please share with our listeners what this article was about? What are some key takeaways that we should take note of?
Yeah, so this article was three junior silver miners. So we did the Guanajuato was in there, then Silver X was in there, and Abra Plata. So I just felt that I wanted to share. I need to write articles on Seeking Alpha. I can't just ignore it. So I like to write an article on there once a month, once every 2 months. So I just, what am I going to write about this time? So I decided, okay, let's just do some silver juniors. People are interested in these. So remember I talked about how Guanajuato doesn't really have very many red flags. So that was kind of the same thing with these other ones, Silver X and Abra Plata. Although people would argue that Abra Plata and Silver X have location risk. And they're right, they do have location risk, but these are, junior silver miners. So they are going to have some risk, but I just thought the risk reward on these three miners was really good. And so I decided to share them with people. And so, this is how I started off, and I was following Bob Moriarty. I was always looking for leads, looking for, which junior miners, look nice. And so people are always looking for opportunities, if you will. So I'll be doing this more and more. 2 and 3 stocks, I'll basically throw them out there and say, okay, I like the risk reward on these stocks. And I try to let people know what the risk is on these. And maybe I'm going to miss some of them, but I always try to point out that the key is always going to be the price of silver. If you're not speculating on higher silver prices, and I mean that seriously, speculating, you're not expecting higher silver prices, but you're gambling, betting on higher silver prices, you should not be investing in silver junior miners. Very high risk.
So Don, as you know, this podcast is to inspire people about achieving their greatness and enhancing their personal well-being. What is your definition of greatness?
So some people like me to talk about woo. I talk about woo once in a while. So I'm basically a metaphysical writer. So my philosophy in life, if you will, is that we are here for kind of 2 purposes. And the bigger purpose is bigger than ourselves. So I believe that the whole meaning of life is to be a conscious instrument of the divine presence. So that's a big one. That's the meaning of life. But most people are not doing that consciously. Only a few people are. It's not easy to do that. A conscious instrument of the divine presence? Are you kidding me? But I'm an old soul. So in order to do that, you are giving back to humanity, but you are trying to be kind of a piece in the puzzle of trying to bring humanity higher, to a higher level. How do you help humanity? What is your piece in the puzzle? Where do you fit in? How do you help humanity? So to be the greatest person that you can be is really being the greatest person for others. But it's not an easy mission. So I'm kind of way up there on the scale as fine, trying to achieve that goal. So I've been doing that since my late 80s. It's a spiritual path, if you will. And everything, it's a holistic lifestyle. So what I talk about is in my books is basically learning how to marginalize the ego. But most people aren't, this isn't for everyone. Most people really, if they're not ready yet, if it isn't their lifetime yet to do that, to basically live with a bigger eye on something bigger than yourself and to focus on that. Yeah, you also have your own personal kind of goals and, that you want to achieve in this lifetime, but those are secondary. Those are not to the bigger goal. The bigger goal is, how does my path fit in to help humanity? That's the bigger one. But again, this isn't for everyone. Not everybody has to live this way. It's okay in this lifetime to focus on you and your family. That's okay. There's nothing wrong with that. It's okay to focus on you, to have to live the greatest life that you can possibly live and focus on your personal goals. There's nothing wrong with that. It's okay. I'm not going to be judgmental in the slightest degree. Somebody's going to live a really selfish, self-centered lifestyle, and they're not going to focus on humanity. That's fine with me. That's not their journey. Everybody has their own journey. But my journey is to find out how I do fit in with more of the we focus than the me focus. So, giving back and help people how to, make money on gold and silver. That's part of me giving back. I'm doing that now because most people don't care about the spiritual path yet, what I call the truth. But I feel in the future they will. And once the truth starts coming out, then I'll flip and I'll start switching and teaching people about spirituality instead of gold and silver mining stocks. But thanks for asking the question. A little bit of woo.
It's so interesting to hear about it, and I appreciate you for being transparent and kind of sharing that.
Yeah.
Where can our listeners go to connect with you online?
Yeah, so I wanted to recommend a book that I recently read. I don't read nonfiction, or I don't read fictional books very often, but somebody recommended this book called The 5 a.m. Club, which, have you heard of it? Yeah, I highly recommend that book. And the reason why is because he has a holistic approach to basically being the best person you can be. And he basically said that, basically health and spirituality are just as important as anything else, right? And that's what I've been saying, that's how I live my life. It's holistic, every part of your life. If you want to be the greatest part of you. And he basically says that the only thing that really gives you joy, if you will, is not material success. It's really emotional success. So how do you achieve emotional success, right? And that's not about basically feeling narcissistic and puffy about yourself, because that doesn't give you emotional satisfaction. Emotional satisfaction is in the heart. It's not in the head. It's not, okay, I have 3 Lambos in the driveway. That's really not, and that's what this book really points out, is that's not really what is going to give you satisfaction. So the book is fantastic. So I'd recommend the 5 a.m. Club by Sharpa. Yeah, that's a great book. Find me. So yeah, Gold Stock Data. You can click the contact us. My book is on there. And then all my spirituality books, you can just search my name, Don Durrett, on Amazon, and you'll see all my books. And then since we're bringing in a little bit of the woo, I actually have a second webpage, dondurrett.com, has all my spiritual books on it.
That's great. So I will make sure to put all that into the podcast notes there. And Don, I really want to take the time really to thank you for being here. Thank you for being on. Thank you for sharing all your wisdom. And I look forward to having you on again.
Yeah, let's do my health book. So I wrote a book called Get Healthy, Stay Healthy. So that's a holistic approach to health, if you will. And that it includes basically, everything that I've learned, since I started in my 20s. So it's a 35 plus year journey for me, staying healthy as well. So that book, we can do one on that and help people, because I think the millennials, people, you really don't have to worry too much about your health in your teens and maybe even your early 20s. But once you get to your mid 20s and your early 30s, it's kind of time. It's kind of, okay, it's time to start thinking in terms of health. How do I take care of myself? I'll give an example is like my dad. My dad and me were opposites. My dad he was a Leo, and he lived for himself. So he ate whatever he wanted to. He drank a lot of scotch. He smoked cigarettes, and he didn't care about health in the slightest degree. He just lived, for himself. He never really cared at all. And he did not make it to 70. He passed when he was 67. And it was it was kind of a absolute direct, 100%. He could have easily, but he enjoyed, he wanted to live that way. That was his focus. That's how he lived his life. But if you want to add 5, 10, 20 years to your life, and you want to have a healthy lifestyle, you have to educate yourself on it. It doesn't come natural. I'm still learning about this stuff. 30 years later, I'm still learning about it. This is an ongoing thing. You have to basically make a commitment that I'm going to get healthy and I'm going to stay healthy. It's a focus. It's no different than I'm going to invest money and make money. It's a commitment. It's a commitment to health, basically. So we can definitely do talk about that, and people can learn a few things.
Yeah, no, I'm up for that. Yeah, Don, thanks so much for everything. Hey, thanks again for your time. And I can't wait to have you back on to talk about any of your other books and passions that you have, because there's more than Don Durrett besides gold and silver.
That's for sure. All right. Thanks for having me on.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review.